You're never gonna work again. Sounds like it should be a good thing, right? Not so much. For most people, that's actually their biggest worry when they know they're about to enter retirement. That's because now they'll need to rely on their retirement accounts and their investments to be able to sustain their quality of life during their retirement years. But the question is, should you have your money in the stock market if you're entering retirement? You see, after working with thousands of families over the years, we have seen that the answers differ for most people. And lately, even more are saying that the stock market is too risky for retirees. So about 15 years ago, our firm ended up meeting with a gentleman who had just recently retired in January of 2007. He had saved up about $1 million for his retirement, and he had been told over the years that the stock market averages about 10% a year, especially if you're looking at indexes like the S&P 500. So his thought was, well, hey, if I have $1 million and it's averaging 10% per year, then that means that I have the ability to take out $100,000 a year and I will never deplete my principal. Well, in theory, this does sound right, but in real life, this is not how money and the stock market works. As you may remember, towards the end of 2007, the stock market started crashing due to the real estate bubble, which affected many banks and institutions. And by March of 2009, the stock market had dropped by over 50%. This means that in his first 2 years of retirement, he withdrew $100,000 twice for a total of $200,000. And then on top of that, he also suffered a 50% drop of the stock market by March of 2009. His $1 million account from 2 years earlier was now down to only $400,000. So just like that, a $1 million account is down $600,000 2 years right after he retired. So does this mean that no one should have their money in the stock market? Well, you just have to ask yourself a couple questions. Number one, will you be using this money to live off of during your retirement? If the answer to this is yes, then yes, that's going to be very dangerous if you suffer a big drop early on in your retirement years and all your money is in there. And if the answer to this is no, then now you need to ask yourself, are you able to handle large amounts of volatility on your money on an emotional level? You see, that's the important part. This is the reason why we strongly recommend people as they enter retirement to go through something called the 3-bucket approach. Bucket number 1 will be your buckets where you will use as your checking account and any other money market accounts which will normally hold your emergency funds of about 3 to 6 months. Bucket number 2, you'll be using as your income producing funds. This is where you'll have assets like fixed income, dividend paying stocks, or income producing annuities. This will be the bucket that you would use to fill up your checking account on a monthly basis to maintain your quality of life during your retirement. And that gets us to bucket number 3, which will be designed as your growth bucket that you will use for long-term growth purposes. This bucket will tend to have more risk, but since this is a bucket that's not going to be used for day-to-day living expenses, then the volatility is something you may be okay with, since bucket number 2 will be the one that will be used to pay for your bills every single month. If you or anyone you know is entering the stage of retirement over the next 5 to 10 years, feel free to reach out. You can have a free 90-minute session with one of our wealth advisors, and they can walk you through the ideal breakdown of your retirement game plan.